Brad Williams, Frugal Finance, valuation. This will be a very simple, straightforward discussion on valuation. And there's going to be some duplication here towards the bottom. In the previous tutorial, we were talking about default risk. Well, I have to include that here in the valuation. And for those of you who did not take the expected return course, I have to present the bond rating information. With that being said, valuation, how to add value to a company. Value. We're looking at value to a company. Can small private general contractors add value to their business? The question I pose, you may be a small general contractor and you're commenting going, if one is to believe in U.S. construction industry averages, the answer is no. Averages. We say no, but contractors will state, we make a lot of money. That may be true, but making money and adding value is not the same. So let's see how the numbers work out. We looked at a total of 210 U.S. publicly traded construction engineering, home builders, and construction material suppliers. And what we found is not at all surprising. The median operating margin is 5.16%. The median cost of capital is 5.89%. And the median return on capital is 8.16%. What we found looking at small general contractors with an average construction project size of $3.5 million was a surprise. We used the median operating margin of publicly traded engineering and construction companies of 5.16. General contractors equity of 75% and a 25% construction line of credit for debt. The cost of capital we computed for small private general contractors is 12.9%. This was 3 years ago when I did this, I think, 2021. And interest rates were menial. They were probably, 2 or 3%. Today, this 12.9 is going to be near 16% or higher. And the after-tax return on capital is approximately 7.44%. Got that? This 12 is probably 16 today. That is a huge number. That's called a hurdle rate, and that is a huge number. The general rule of thumb is if the after-tax return on capital is greater than the cost of capital, accept the project. If the after-tax return on capital is less than the cost of capital, reject the project. In other words, are you earning after tax, and this is going to be nearly 11%, the after-tax return on capital hurdle rate, are you earning 11 to 12% on your construction projects? When on average, it is significantly lower. It appears in general, small general contractors are not adding value to their company. Instead, they're stripping away value project by project. You're going, what are you talking about, Brad? If this is a general contractor commenting, how long do you stay in business? 3, 4 years. Why? You make money, you continue making money, but you're not making this marginal return. A return that will add value to your company, allow you to grow and subsequently sell your business for a sizable sum. There are tens of thousands of sole proprietors out there in the construction industry. That should tell you something right there. That number is stable. It's stable only because the dropout rate is so high and the barrier of entry, you need your general contractor's license. That, like a real estate agent license, is not that difficult to get. Other than that, you can see, while, yeah, you're making money, but are you adding value? Value, what is it and why you should care? Ask a small general contractor if they're adding value to their business, and with an honest answer, they'll tell you, hell yes, we make a lot of money. Making a lot of money versus adding value are not the same. Value is the cash flows you accumulate after 30 hard, back-breaking years as a general contractor. It's what you get when you sell your company. Simply, if you earn a return on capital greater than the after-tax cost of capital, you increase the value of your company. If you earn a return on capital less than the after-tax cost of capital, you destroy value from your company. The project. We made up a hypothetical company, Capital Construction. a small general contractor who's been asked to construct a self-storage facility for an owner. To see if it makes sense for the contractor to do so, we will use the industry average financials of 210 publicly traded construction companies to show why the average small general contractor may be making money but not adding value. Here are the assumptions and project details. Assume it's a 1-year self-storage construction contract. Project costs $3.5 million, including profit. Operating margin, 5.18, U.S. industry average. No depreciation, working capital, CapEx, or salvage value. Why? Because this is a one-shot deal. It's just a construction deal, so you're not depreciating anything, maybe some tools. Your working capital, no. CapEx, no, because general contractors will contribute his own equity for months 1 to 6. Here's the deal. When you step into a project like this, 3.1 million, there's going to be draws from the owner, and the owner may stipulate, look, you're going to have to put some skin in the game, and you need to put some equity in as we roll through this thing. In other words, you're going to have to buy all of the lumber. You're going to be responsible for the groundwork, the engineering, and we're going to pay you back, clearly, as the owner. This is the way we do business, or we'll find someone else. And then short-term debt is used for months 6 through 12. Owner pays general contractor 3 times, 25% at the end of month 5, 25% at the end of month 9, and 50% at the end of month 12. All cash inflows will be contributed back to the general contractor, and then debt. All interest costs and debt will be paid at the end of month 12. We will use a bottom-up beta to compute a total beta. The cost of debt is 6.99. We added 5% small contractor premium. The effective U.S. tax rate, 25%. The current equity risk premium, 431. The median industry average at the equity ratio, 25. And the current 10-year risk-free rate is 1.29. Well, guess where that is now? That's 454. I looked this morning, I think it's 454. Just add 3% right off the top in your valuation. What is all this foreign language? I'll talk about all of this stuff as we move forward. The financial fundamentals, borrowing risk, default risk, and the cost of debt. When a bank lends to an individual or company, there's a chance that the borrower will not make interest and principal payments on the borrowing. This prospect of default is called the default risk. In general, borrowers with higher default risk ought to pay higher interest rates on their borrowing than those with lower default risk. This section looks at the extent of default risk and the association of default to interest rates on borrowing. Understanding default risk, the default risk of a company is the function of its ability to produce cash flows from everyday operation and its financial responsibilities, including interest and principal payment. It is also a function of how liquid a company's assets are, since companies with more liquid investments should have an easier time liquidating them in a crisis to meet these debt requirements. So the following relate to default risk. Companies that generate high cash flows relative to their financial debt requirements generally have lower debt risk than do companies that generate low cash flows relative to their debt obligation. Thus, companies with large current investments that generate significant cash flows will generally have lower default risk than with companies that do not. You are the general contractor, you're building this thing, you're responsible for 25% of the costs up front. How are you going to afford that? Maybe you have a line of credit. You should have a line of credit. But if you don't, you're using your equity. And if you're using your equity, we have to determine your cost of equity. It's part of finance, all right? In order to have a balanced company, you're going to need an optimum debt ratio for your projects. We're not going to get into the microscopic level, but there's an optimum for pretty much everything within the finance arena, including whether you should use a line of credits during your construction projects. The more stable the cash flows, the lower is the default risk in the company. Companies that operate in conventional and predictable business will have lower default risk than with otherwise similar companies that operate in a cyclical or unstable business. The more liquid a company's assets for any known amount of operating cash flow and financial obligation, the less default risk. Default risk and interest rates, when banks did much of their lending to companies, it made sense for banks to expend the resources to make their own assessment of default risk, and they still do for most lenders. The arrival of the corporate bond market produced a need for third-party estimations of default risk on behalf of the bondholders. This demand came from the need for economies of scale, since few individual bondholders had the means to do the estimations themselves. In the United States, this led to the expansion of rating agencies like Standard & Poor's and Moody's, which formulated conclusions of the default risk of corporation using a mix of private and public information, transformed these conclusions into measures of default risk, bond ratings, and made these ratings public. Investors buying corporate bonds today use the bond ratings as a shorthand assessment of default risk. Bond ratings, the method of rating a bond begins when a company asks for a rating from the rating agency. This request is typically carried out by a company wanting to issue bonds. While ratings are not a legal prerequisite for bond issues, it is unlikely that investors in the bond market will be willing to buy your bonds issued by the company that is not well known and has shown itself to be unwilling to put itself through the rigor of a bond rating agency. Bond rating process. It's not a surprise that the largest number of rated companies are in the United States, which has the highest number of active corporate bond markets, that there are relatively few bond rated companies in Europe, where bank lending is their normal practice for all but the largest companies. The rating agency then gathers information from both publicly available data, such as financial statements, and the company itself, and makes a judgment on the rating. If it disagrees with the rating, the company is given the chance to submit additional supporting documentation. Here is a schematic of the process. There is the need. There is the process. You're going to ask. They're going to evaluate. They're going to give you an answer. You can ask for a reevaluation otherwise. You're sitting there going, why are we going through this process? You are the contractor and you're interested in this, and you're saying, well, what's the point of this, Brad? You're a private company. We don't know anything about you. We need to evaluate your ability to do this project. You know how to put a building together, fine. But do you have the financial resources to carry the project? Our company, we've been around for 400 million years. The reason why is because we cross the T's and we dot the I's. We have a finance department and we have a bunch of folks, and they crunch the numbers. And they're very good at it. They're fast, they're efficient. So your project took an hour of our time. Doesn't cost us much. But now, because we use industry standards, we can't use your information because you don't have any. We use industry standards, okay? When I said at the very beginning, we looked at 210 companies, we're going to use that to make a determination of whether we want you as a client. All right, I know it's harsh, but this is just the way things work. How does this play in your hands? Well, one, what they're going to do is they're going to look, and perhaps they'll create a synthetic bond rating. In other words, they're going to look at you. They're going to look at your ability to do the project, whether you have the financial resources to carry that 25% cost requirement, or maybe up to 50%. And if not, then the conversation's over. They're going to go through and they're going to rate you. And here are the ratings from AAA to D. If after they crunch the numbers, they see that you're a double B contender for the job, most likely they're going to turn you down. Maybe you have a history of not completing projects. Maybe you filed bankruptcy 6 years ago and you've turned around and your company is profitable. Maybe there'll be a stain against you and a non-favorable evaluation. Investment grade and junk bonds, that's what we're looking at. This is all hypothetical. Now, don't be stressed out if you're a general contractor going, is this what they do behind my back? Well, if it's a large project, you should have a finance department of your own to determine whether you have the ability to do this. Or an accountant, and though an accountant doesn't do valuation, if they do a crappy job at it. They don't do this. They don't look at and determine whether you're rated as either a AAA or a D. So with that being said, while ratings can range from AAA to D, a rating at or above BBB by Standard & Poor's is labeled as investment grade, suggesting the opinion of the rating agency that there's comparatively modest default risk in investing in bonds issued by these companies. Bonds rated below BBB are generally identified as junk bonds or as high yield bonds. While it is a subjective dividing line, it is a critical one for two reasons. First, different bond investment portfolios are constrained from investing in bonds below investment grade. So the demand for investment grade bonds tends to be greater and deeper than that for bonds below the grade, which leads me into the next area that you as the GC are going to go through when you ask for that line of credit. If you step into your local bank saying, I need a $500,000 line of credit, this is exactly what they're going to do. They're not just going to go, here, Mr. Jones, here's $500,000 because you've had a banking account with us for 10 years. They're going to ask you for your financials. They're going to ask you for your returns. They're going to ask you for future projects. How do things look? How are you going to pay? How are you going to secure this line of credit? What's the collateral? So on and so forth. They want to know your ability to pay, and then they're going to do this. They're going to put you on this scale, and then they'll make a determination as to what interest rate. If they elect to do business with you, then they'll put an interest rate, and it could floor you. In other words, it could be so ridiculously high, you're just saying, this is not fair. And then you're going to find other ways to possibly fund this project. This is the cycle you're going to go through in order to stay in business and grow your business. So you're going to have to take some risks. But then the bottom line here is, what is that interest rate you're going to pay for that line of credit? And that's the determining factor. And then after that, it is, what's my profit on this deal? So you have your debt exposure, the cost of debt, your cost of equity, return on capital, and a return on equity. And that's what we're doing here. We're evaluating the project. We're evaluating you. We're evaluating the returns. And then ultimately, we'll determine if you're a good match. So worksheet 1 shows default spreads at a point in time. You can see if you're AAA, you're going to pay a much lower rate than if you're BBB. You can see right here, BBB, look at the spread. You're going to pay 190 on AAA, or okay, you can pay as low as 1.8%. Here are the default spreads. Inadvertently, I sorted this, and this is how Excel will sort, and it's wrong. This AAA should be top. This AA should be second, and then A1, A2, A3. So these are a little bit out of order, but common sense says AAA is the best, so on and so forth. A AAA would be whatever this lowest rate is. Worksheet 1.3 shows default spreads at a point in time, but default spreads not only fluctuate over time, but it can change for bonds with an identical rating, but different maturities. For the bonds with higher ratings, the default spread usually widens for the longer maturities. You see this huge spread here. So we have D, and then you can see over time, 820, 1031, 129, 21. See how volatile this can be based on market events. 8.2 of 20, this rate in the green was significantly higher than it was as of 7/28/21. Why? This was probably COVID. And as things started to calm down, you can see the effect. All right, there was a panic. This is market related activity. And you can see the volatility. There's nothing you can do about this. You can't diversify this. This is just the market. For the bonds with higher ratings, the default spread way over here with higher ratings, AAA is the highest rating. You can see it's almost a yawn event between yields or prices. I don't know if this is price, yields, right? Yawn, yawn, yawn. But as the risk increases, the cost of money can just go off the rails. Many people, especially in the real estate industry, especially in construction, don't give a hoot. They're just saying, all I care about are the cash flows, so I'm going to leverage my real estate to the highest there is, highest possible level within reasons. It's not uncommon to see 80-90% financing on commercial projects. Well, there's usually what's called duration risk. There's a huge mismatch. When you see something like this, find yourself, because now you're over leveraged, some event happened and interest rates skyrocket, guess what? Two factors. One, you're going to be stuck with significantly higher rates when you either refinance or maybe you were foolish enough to have an adjustable rate deal and you didn't swap it out or you didn't hedge. That being the case, you're going to see a huge reversal in your cash flows. And when you see events like this, it's going to have a trickle-down effect towards your business, towards any growth, and towards the size of the company. You're going to end up, generally, prices are going to drop, your cash flow is going to drop, the number of workers, you're most likely going to have to trim back the number of workers. You're going to find fewer growth opportunities, but still, you're stuck paying this higher rate. So you can see why successful companies with the higher ratings and the lower in their rates continue and plug along in good times and bad. And that's the moral of the story is you have to manage your finances. And general contractors generally don't. Note how much default spread changed through 2021. This suggests that default spreads for bonds must be re-estimated at regular intervals, particularly if the economy shifts from low to high growth or vice versa. Risk measurements and hurdle rates in practice. I'm just going to introduce the cost of equity here. I mentioned it briefly, but the cost of equity is the rate of return that investors demand to invest in the equity of a company. All of the risk and return models talked about previously require a risk-free rate and a risk premium in the CAPM. We start by talking about those familiar inputs before directing our attention to the evaluation of risk parameters. Brad Williams, Frugal Finance. Thanks for watching.